Hello, fellow compounders. Welcome back. Have you ever wondered how you could increase your investment returns? You can do so by avoiding costly mistakes. Remember that if you lose 50% on your investment, it actually takes 100% gain to get back to even. So, in today's video, we will be pointing out 6 critical mistakes that dividend investors should avoid at all costs to achieve long-term investment success. By sidestepping these pitfalls, you can position yourself for financial growth and secure a stable income stream. Are you ready to learn the secrets? Let's dive in. This video is for educational purposes only and should not be considered financial advice. I am not your financial advisor and you're responsible for your own financial decisions. Mistake number 1 is chasing high dividend yields without doing due diligence. Many investors are lured by high dividend yields, but let's remember the famous saying that says, if it's too good to be true, it probably is. Let's use the example of Kinder Morgan, one of the largest pipeline firms in North America. In 2015, it was offering an unusually high dividend yield of close to 7%. Upon closer examination, you would have discovered that the company's financials were not that great, and their payout ratio was well above 100%. It actually was 392%, meaning that it was paying out dividends that were almost 4 times what it was earning in profits. Obviously, that couldn't be sustained, so the company had to cut its quarterly dividends from 51 cents per share in the fourth quarter of 2015 to 13 cents per share in the first quarter in 2016. Remember, it's crucial to conduct thorough research and prioritize quality companies with sustainable dividends. Moving on to mistake number 2, neglecting the fundamentals. Dividend investing should not solely rely on dividend yields. It's critical to perform fundamental analysis of the company's financial health, growth prospects, competitive advantage, and industry trends. If you ignore these factors, you might invest in companies with weak fundamentals, which may not be able to sustain dividends in the long term. And worse, they could destroy value and make a hole in your portfolio. Mistake number 3, neglecting dividend growth. Let's consider Waste Management Corporation, a company that has consistently increased its dividend by 6.3% on average every year for the past decade or so. When I bought Waste Management in 2011, my yield on cost was 4.5%. Specifically, I bought 400 shares for $12,252, and it paid me a $556 dividend in the first year. Now, in 2023, those 400 shares are paying me $1,120 per year. That is double what I was receiving at the start. My current dividend yield on cost is 9.1%, and it's all due to the dividend growth over the years. The lesson here is to don't overlook dividend growth. You might miss out on the potential for significant returns and a growing income stream. Investing in companies like Waste Management, which have a track record of consistently increasing dividends, can provide a compounding effect that will add to your investment success. Mistake number 4, failing to diversify. Imagine if you had invested all your dividend portfolio in the banking and financial sector, focusing solely on quality banks like JP Morgan, Bank of America, Wells Fargo, and some of the top regional banks. While the banking industry can offer promising returns, it is also susceptible to rapid changes and volatility. Do you remember what happened in 2008? The mortgage crisis. The mortgage crisis caused a major disruptions, and regulators forced all banks to suspend their dividends. Or if you were only in one sector, you are susceptible to major disruptions such as new regulations or a shift in consumer preference. Your entire dividend income could be at risk. Diversification, meaning that you spread your investments across several sectors like healthcare, utilities, and consumer goods, helps you mitigate this risk and provides a more stable income stream. Now let's move on to mistake number 5, failing to monitor company and industry changes. Let's say that you had invested in Kodak Corporation. For those of you who are younger, before we had smartphones or digital cameras back in the 1980s, we used to have cameras that used photographic film. Kodak was the leading company in providing film for those cameras. Over time, we noticed a decline in film cameras and the shift towards digital cameras and smartphones. Kodak eventually went bankrupt in 2012 due to the shift to digital photography. The irony is that Kodak invented the digital camera, but didn't act on it because it would have affected their film business. The lesson here is to stay informed and regularly review your investments, which will help you identify shifts in the business landscape and make it easier for you to make necessary adjustments to your portfolio. Last, but certainly not least, mistake number 6, failing to understand that dividends alone don't increase your wealth. Profits do. Dividends just move money from one pocket to the other. Let me help you understand using an example. Let's say that you own a candy store, Sue's Candies. And Sue's Candies has a book value or net worth of $100,000. This year, Sue's Candies made $20,000 in profit. So its book value is now $120,000, its net worth. The $20,000 of profit is sitting in Sue's Candies bank account. And remember, you own the business. You know it's worth $120,000. If Sue's Candy paid out a $20,000 dividend to you, how much would Sue's Candies be worth now? $100,000, right? It doesn't have the $20,000 in the bank anymore. You, as the owner, now have $20,000 less the taxes you had to pay for dividends. Well, but that's another story. Let's assume that you lived in a world with no taxes. So now you own $20,000 that you received in dividends in your personal bank account, and you own a business worth $100,000. So you might say, wait a minute, I did increase my net worth by $20,000. The proof is my bank account. In reality, your net worth was increased by the profits the business earned, not the dividend it paid. If you didn't receive the dividend payment, Sue's Candies would be worth $120,000 instead of $100,000. So you would still own $120,000 in the business. In effect, you just transferred $20,000 from one pocket to the other. Your wealth is still the same, $120,000, whether it's $120,000 in the business or $20,000 in your bank account plus $100,000 business. It's the same. So most dividend investors get carried away by focusing only on the dividends paid out by the stocks, when in fact they should focus on the profits the business make and the sustainability of those profits. Dividends are just the byproduct of the business profits. So understanding the importance of investing in profitable companies sets the foundation for long-term net worth growth. There you have it, the 6 critical mistakes in dividend investing. By sidestepping these pitfalls, you'll be well equipped to build a strong dividend portfolio, secure a reliable income stream, and maximize your investment potential. If you have any questions or want to share any insights, please post them in the comment section below. Remember, always be compounding. See you in the next video.